Everyone learns Fibonacci, but most traders still lose with it because Fibonacci without market structure is useless. Watch what happens when structure breaks. This is where Fibonacci actually starts working. Hi, my name is Ian Coleman and I am a senior analyst at FXStreet. In the first episode of the Fibonacci trading series, we discussed the basics behind the concept. In this video, we're going to go deeper to help you understand the market structure that drives price action. What is market structure? Simple market structure is the most basic way of reading price action by only looking at higher highs and higher lows, lower highs and lower lows, nothing else. If price is making higher highs and higher lows, we are in a bullish structure or an uptrend. If price action makes lower lows and lower highs, we are in a bearish structure or a downtrend. In the smart money strategy, traders note a break of structure. This will often denote the end of a trend and a flip in sentiment. However, this only applies in trending markets. Did you know that markets are non-trending or in consolidation mode between 60 to 70% of the time? This is where a lot of newbie traders lose their money. When we see an asset consolidating, it means that institutions or smart money consider the price to be fair value. There needs to be a shift in sentiment for the asset to break out. Markets will move from range trading to impulsive breakouts and then back to fair value consolidation. This sequence repeats over time. The big money is made by reading the market structure and trading the impulsive trends. Fibonacci is my go-to analysis tool to achieve this. We know that markets move from balance or consolidation to imbalance or trending. The imbalance occurs when smart money decides that either the asset is overvalued or undervalued, or in the case of FX crosses, one side of the exchange is incorrect. When we see an imbalance and a break of market structure, this is our opportunity to use our Fibonacci extension tool. The markets will often extend to 161.8% and 261.8% and possibly further for commodity-based products. High volume can confirm a valid breakout. In products where this data is not available, traders look for candles to close near the top or bottom of their range. This confirms strong intent. We can also gain some very fruitful entries within periods of balance or consolidation. As this is a more complex Fibonacci trading strategy, we'll discuss this in more detail in our final video of the series. So we see a break of structure. Now, what next? Traders will look to the 161.8% Fibonacci extension level as a first target. It is then very healthy for the markets to enter a period of balance once more. This can be analysed as a period of consolidation or merely profit taking. The Wyckoff theory would suggest this is where smart money enters a period of accumulation or distribution, big money players loading or offloading positions. After that period of consolidation, we see another imbalance and a move to the 261.8% extension. This will often complete the series. Retracements and periods of consolidation are healthy within a trend. Overlapping wave patterns are not. This can signal that the current trend is coming to an end. A move from higher highs and higher lows to lower lows and lower highs. A break of character or a break of structure on the smart money concept. A reversal close to the 261.8% extension level. When these occurrences happen, it's time to look at the Fibonacci retracement tool. I would use the basic levels of 38.2%, 61.8% and 78.6% at the outset. Applying all the retracement levels can cause confusion. Impulsive waves are normally in 5-wave structures. Retracement patterns are normally in 3. Watch for the completion of the reversal formation at one of the basic Fibonacci levels. We have spoken about top-down analysis in previous videos. This is the art of analysing higher time frames to note where we are in a bigger cycle. This type of analysis is essential for Fibonacci trading. What made it look like an impulsive move lower on a shorter time frame may just be an accumulation of liquidity or a pullback in a longer time frame. Don't miss out on our last video in the Fibonacci trading series, where we will discuss combining retracement and extension levels. Hit the notification button on our YouTube channel to get an automated alert.